oh boy, charitable contributions and the dividends received deduction. Here, I made a note. We will cover corporate treatment for these two in our lesson on corporate net operating losses and capital loss limitations. However, we're going to briefly cover them here. I mean, they're popping up everywhere in corporations, so it's kind of hard to avoid them. But just keep in mind if there's something that you didn't see here and you're thinking, oh, I know I should have seen an example about that. Well, we've got it coming down the line for you. Diving first into charitable contributions, we've seen this, we've mentioned it. It's nothing new, but obviously this is the most in depth we will have gone thus far. Under U.S. federal tax law, C corporations are allowed to claim a deduction for charitable contributions made to qualifying organizations during the year. Now, if you're inquisitive like me and you're always asking questions in your head, C corporations, what about S corporations? Well, those are separately stated items that'll flow through to the taxpayer. Glad you asked that question. Keep asking questions like that. Stay sharp because you'll see all these different entity types on the exam. The deduction is limited to a percentage of the corporation's taxable income, typically 10%. Yeah, that's the amount, unless that radically changes. That's what we're going to be using for the exam. If a corporation's charitable contributions exceed this limit in the particular year, the excess may be carried forward and deducted in up to 5 years succeeding tax years, subject to the same 10% limitation. Example here being, suppose that ABC Corp has taxable income of $100,000 and makes charitable contributions of $15,000 to a qualifying organization. Now, remember how we did this in the example a couple slides back? We have to take into account all the other expenses first, the other deductions. Now, in year one, Corporation ABC can deduct 10% of its taxable income. We see this here, $10,000 maximum as a charitable contribution. The remaining $5,000 exceeds the allowable deduction limit for that year, and this $5,000 as such will be carried forward to be deducted in the up to 5 succeeding tax years, subject to the 10% limitation in each of those years. And let's keep it rolling. Let's keep the example going. For example, if ABC Corporation has taxable income of $80,000 in year two, the maximum charitable contribution it can claim for that year is $8,000, which we get from the $80,000 times 10%. Since the carried forward amount from year one is $5,000, Corporation ABC can fully deduct the excess contribution in year two. In this case, there would be no need for further carry forward as the entire excess amount was deducted in year two, sending us on our way. We're good to go. Nice simple example. Obviously, they get more complicated, but we are preparing you quite well. Keep it up. Make sure you're practicing multiple choice questions and sims as you're going about your day. Now we arrive at the dividends received deduction. Oh boy, oh boy. First off, just memorize this, please. Please memorize this. Just do it. Please do it. It's actually funny. This actually does come up as well. Sometimes on the financial exam, very rarely, and it's just odd when it does. But this is something I would just know for sure. The DRD is a tax deduction that allows corporations to reduce their taxable income for a portion of the dividends they receive from domestic corporations. That's important to keep in mind. You can't do this for non-domestic corporations, international, foreign, something like that. The DRD rates depend on the ownership percentage of the corporation receiving the dividends. Additionally, in order to qualify for the DRD, a company must have owned the investee's stock for a minimum holding period of more than 45 days. We don't want companies flipping stock and kind of like wash sales, dealing with more shorter transactions. The brackets here are as follows. So if I'm a company, if I'm a corporation, not an individual, because you can't deduct part of your dividends for an individual. This is corporations only. If you own zero, not zero, but 0.0001, right? Because if you own zero, you're not getting any dividends. But if you own less than 20% ownership, you're getting 50% deduction. We'll see how that works down here. 20 to 80% of ownership, 65%, and then more than 80%, 100%. It's like you're just giving yourself a dividend at that point. You're not going to get taxed on that. Let's assume that company X receives dividends from 3 different domestic corporations with varying ownership percentages. So you could say something like Walmart owns stock in Lowe's, Home Depot, and some other company. This would be what we're talking about here. Dividends from A, B, and C. We see that we've got different dividends. We got in each rate, we've got a less than 20%, a between 20 and 80%, and then an over 80%. Now let's calculate the DRD for each dividend based on the ownership brackets. I mean, these could also be subsidiaries. This might be Walmart USA, and maybe this is Walmart South America, something like that. So that's why you'd see such a high ownership percentage. Calculating the DRD for Corporation A, that's less than 20% ownership. The rate here, we just met, well, we have that, I say look at the chart, but we have that memorized. 50%, we're going to take that. That's $30,000 times 50%. So we're only actually, of the $30,000 of dividends we received, which normally you'd pay tax on $30,000 of dividends, you're actually only paying tax on $15,000. We're going to see how the amount of tax we're paying on the dividends here for Corporation B, which is 20 to 80% ownership. That's 65% times 40. That gives us $26,000. And then for Corporation C, this one is 100%. So we get the full deduction. We're not going to pay tax on that. So our total deduction here, now keep in mind, this is the deduction. This is what we're not paying taxes on. The total deduction is $91,000. That comes from the 15 plus 26 plus the 50. So in total, normally we would have had to pay tax on 120,000, which is the total amount here. But now we get a deduction of 91, meaning 120 minus 91. That is the portion we're paying tax on. In this example, we can claim a DRD of $91,000 based on our various ownership brackets and corresponding rates. Now keep in mind, the question could be tricky. It could ask you, what is the dividends received deduction? Or it could ask you, what is the total taxable amount after the dividends received deduction? And in which case you'd have different answers. If it asked for the total DRD, that would be $91,000. But if it asked for the taxable amount, that would be the 120 total minus the 91, giving you $29,000 left. That is subject to tax. Great example of how this works here. Obviously, like I mentioned, we will see how this integrates into a larger question with corporate taxable income, but individually in and of itself, not too difficult. Now we're going to see how the charitable contributions deduction and the DRD work together. We're going to see that these two deductions are generally at the end of the process. We do these when we have the taxable income that takes into account salaries and wages, every other normal operating expense, and then these are done at the end. We saw the charitable contributions being done at the end of the last one. Company A has got the following information: taxable income of $500,000, charitable contributions of 30, and then dividends received of 50. Now it looks like our rate here is going to be that 65%. Here we're going to calculate the amount that Company A can deduct as charitable contributions, considering the dividends received deduction. Just a note here for the 65%. Now, is this 65% ownership, or is this saying we're using the 65% bracket? Well, it doesn't matter, because if it's the 65% bracket, it's ownership of 20 to 80%. So either way, it's going to be the same thing. It's going to be that 65 there. Step one, we want to calculate that dividends received deduction, because we're going to see how we have to do this before the charitable contributions. This is going to be the $50,000 times the 65%. That gives us $32,500. What is our taxable income after that DRD? That's going to be $467,500. And then simply put, we're going to say that that amount, because we're doing the DRD and then charitable contributions is the last. So remembering that order is critically important. We're seeing that the taxable income after the dividends received deduction is what we multiply by the 10% in order to get our limit for the charitable contribution. Now, since the charitable contributions deduction limit of $46,750 is greater than the actual amount of $30,000, Company A can deduct the full amount, which is $30,000. Obviously, as we saw in a previous example, if it is above, you are only going to be able to take the limit. So therefore, we can take the full $30,000, considering the amount from the dividends received deduction. Awesome. Nice, great example. Make sure you're practicing these and able to do them for yourself on the exam. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.